Hi, my name is Dr. Drdavidkingboison, and today we'll be looking at Module 3 in the Certified Management Professional course. And we're going to look at fundamentals of business shrewdness. And in this model, we're going to look at the holistic view of business, key performance indicators, risk management, the learning organization, financial metrics, financial report, management disciplines, and evaluate, analyze, and synthesize, and then key performance or key organizational pillars. So these are the topic items that we're going to deal with within this module 3. I believe that last week you guys were good with what we did in terms of supervising and skill building. Now, we're going to look at this within the context of a typical organization and cite some relevant examples that can help you apply this into real practice. So when we talk about shrewdness, we are talking about one's ability to be able to make sound and good judgment. And we are saying that many people believe that you could be born with shrewdness or acumen. Acumen is the ability to make sound judgment, okay? And they do that loosely, but this is a skill that has to be developed. And knowing what is necessary to navigate and create a successful business seems something that is innate for certain people. But I mean, Steve Jobs, for instance, showed great business with acumen because he developed it over time, having had that business acumen, already. So fortunately, it is possible for the rest of us to improve our business acumen by learning some key concepts and approaches and practice that will help us eventually to improve the way we manage our business. So looking at business shrewdness from the holistic view, we are looking at the ability of the manager to be able to make financial decisions and also make combine finance, combine strategy to make some sort of decision, okay? In other words, the decision-making process is a confluence of finance, decision-making, and strategy to be able to make informed business decision. And we are saying that business shrewdness and acumen requires an understanding of finance, strategy, and decision-making. These 3 key components are very, very important. Most managers and employees, however, are responsible for specific areas, and they have little understanding of the impact of their decision on other areas. And that is why it's important that as a manager, you are able to have these 3 key components, an understanding of it that will help you make very informed and insightful decisions for your organization. Profit maximization and revenue reduction, cost reduction are key constructs in business growth. And it demands that business man or manager would want to make that success or achieve success would have to merge these 3 constructs: finance, strategy, and decision making, and use that to create that impact that is required as a manager for that person's organization. So in order to make effective decision, it is necessary for you to examine the big picture. And seeing the big picture means that you are bringing other variables in to make it more visible. And you understand the overall organization and impact of the goals and decisions on the enterprise as a whole. So we are saying that business shrewdness and acumen refers to the ability to assess an internal market and make effective decisions. And it requires an understanding of finance, strategy, and decision-making, as I indicated earlier. So there are some key characteristics that managers should look for, okay? So as a leader or a manager, you should build sustainable and long-term interaction with your people. And to achieve that, what you need to do is to be able to build relationships. You should be able to use regular feedback to get some feedback from your staff. And also, you need to do some sort of offering of value. Now, in building relationship, we are looking at you building relationship based on mutual trust and respect and support. Okay, you're building mutual relationship based on mutual respect, trust, and also support. And also in using feedback, you want to request feedback and listen to complaints from customers. Sometimes it's very annoying. You see that staff of some organization will not even listen to the customer. You need to listen to the customer. You need to be an attentive listener to be able to understand what the customer is saying so that you can appreciate the intensity of the problem or whatever challenge the customer is having. So offering value is also another key construct. We're saying that you need to provide value in product and service and communicate such value consistently to your customers. So long-term interactions and processes and relationships are essential for organization growth. And this long-term business success requires that such long-term interactions. And for which reason we are saying that in building these relationships, you need to look at these three things. You build a relationship, make sure that trust is in there, there is respect, there's support, and then you have feedback, and also you offer that product, okay, that the customer will see that he has really exchanged money with something that is valuable to that customer. You are offering a service that meets and exceeds that customers or consumers' expectation. So that is very important. Now, many people use aggressive strategies, okay, in sales and sales tech, in getting their sales, but that sometimes is very, very dangerous, and they don't care what happens. What is important is that they get their sales, that target met. But you see, building long-term relationship now becomes very key, because if you're not very careful, that first impression that you created is going to be a lasting impression. That customer who's supposed to bring other customers is unlikely to do that. Now, so to ensure long-term and sustainable success, it is essential for every organization to recognize growth opportunities. And an opportunity is any project or investment that will create what? Growth. So any project or investment or any strategy that is going to bring or upscale the organization to the next level is an opportunity. And individuals with business shrewdness and acumen are constantly recognizing opportunities for growth. So such people do not see problems as problems. Anytime there's a problem in the organization, they see it as an opportunity to make money or an opportunity to do something to create to create conditions for growth of the organization. They don't see problems as problems. They call problem challenges. A shrewd business person sees things that the ordinary managers may not see. Okay, and for recognizing opportunities does not come easily for you. There are steps to take that will ensure that you do not overlook growth opportunities. And these steps are: one, you need to identify the market trends. You need to also actively research customer needs and also pay attention to what competitors. You also need to monitor demographic changes and also consult employees, monitor abilities of the workforce. So in market trends, you need to know what is happening. What are the leading products? What is our customers saying? What are their tastes and preferences? You need to know. Okay, these information is going to help you leverage, on whatever strategies you have to be able to capture, market share. And we are saying that customers are savvy and they keep changing their tastes and preferences, which is why it's very important that you monitor these tastes and preferences and you try as much as possible to meet these expectations so that they might not, you will not lose them to other competitors. And you need to also pay attention to what competitors are doing. Which innovation product are they bringing or services are they bringing? What are they doing? Are they building capacity in terms of their assets? Are they building capacity in terms of technology? You need to know. And you need to also monitor demographic changes. You need to get the census figures just to know whether there has been growth in demographic, characteristics or indicators, in terms of gender, whether there are more males or females, in terms of what ethnicity, which ethnic group is growing very fast, in terms of, the purchasing power, are salary levels going high or low? You want to look at that. Religious, issues. You want to know which religion is growing very fast. And you know, if you know this, it helps you to fashion out a product and services to meet that particular target. And we say you also need to also consult with employees. Employees should be able to give you feedback, because see, these are the priceless assets you have in your organization. And they are the reason, in fact, they are the raw materials that you use in delivering the service or producing the goods and services. Raw materials are not just those tangible materials you see, like, your stock and other things. They are not just that. The human resource is also an indispensable and also a raw material that, takes other material, churns them out to be able to provide product or services for your organization. And you also need to monitor abilities of what the workforce. You need to know what they are able to do. You need to know you need to do some sort of skill gap analysis to know, which people in the organization are able to create the 80% profits that you have, or which of the 80% create the 20% profit. You need to know, do this analysis, and then get these things right. So once opportunity have been identified, assessed, and analyzed, decision has to be made to pursue them. Decision need to be made carefully and mindfully. And mindful decision making combines reason and intuition to come up with decisions that are based in the present. A leader with acumen follows a structured decision making process, and that's what I want to discuss with you. The first thing is that leader should be in that moment. He should be in that moment. In other words, he should pay attention how physically and emotionally that leader is feeling, so that will help that leader to know whether the decision that he's going to make is a decision that was made on sound judgment, or it had any external influences. That is very, very important. And then it should be that clear. There should be clarity. So you need to investigate for clarity to be able to get the information, the fact. So begin by investigating your feelings and identifying the type of decision you are making. Okay? A neutral decision, for example, should not create a deal of what stress. So you are making a decision, haven't checked your system to know that, okay, now I'm in the moment of making the decision, but I need to know whether there are conflicting views or not. If there are no conflicting views, what am I going to do? Do I have that sound judgment to make a decision? And you should also investigate for clarity, okay, that there is nothing influencing the decision that you want to make. And because if it's a neutral decision, then you shouldn't struggle. And once you identify the decision, make sure you have collected the necessary information and to make the decision. And then after that, you need to make a choice. So once you have all the information, listen to your intuition and write down your decision and take some time to consider the decision. If you are still comfortable with the decision after a few days, then you can act on it. So 3 things: be in the moment, be clear, and then make a choice. This has to do with that business guy or the manager, that's shrewdness manager, who is making decision based on what? Sound judgment. So a leader with acumen follows structured what? Decision making. And then we are saying that the leadership of a company is responsible for the cultural values, and these guides the other aspects of the business. So which are operation, marketing, and finance, and governance, and information and people. So if you are looking for the big picture, this is what we are saying. As a leader, you should be comprehensive. You should be detailed. You should be balanced. Make sure that each area of the company is sustainable. and make adjustments as necessary. And then be incorporated. Integrate every aspect of the business with others. Don't tend to be Mr. Know-all. Show employees how they affect each other and the company as a whole. If you are making decisions, seek for some views from employees, because you cannot know it all, right? You are not a repository of knowledge. So there's a need that if you want to be comprehensive, then seek for views from people, and then be balanced in your decision and make adjustments. Make sure that you are fair, and that decision you are making is neutral. And that will help you look at what the big picture. So we are saying that looking at the big picture allows you to see everything related in the organization. Is that shrewdness business mogul who is able to achieve that? So let's look at some key performance indicators. Okay, so what are key performance indicators? Key performance indicators are that aspect of the business that measures the metrics. Okay, we try to quantify whatever we have done in business, and we do it in such a way that we are able to look at our targets, and then having seen the target, we work around the scene to also achieve that target. And in order to achieve that target, there are certain things we do. So when we have been able to achieve a certain minimum target or appreciable target, the set target is now compared with the actual target that we have achieved. And we do the comparison. So, but that target that you set first is what we call the key performance indicator. And in fact, what we are saying is that everything in the organization we should be able to convert it into metrics. In other words, we should be able to put numbers on them. So key performance indicators, KPIs, need to be developed decisively, and this requires an understanding of the performance measures, okay, in the organization. Creating random metrics will not help to gauge the effectiveness of the organization. Just doing that will not help, but you need to define KPI decisively, and you must follow these steps. And the first one is that you need to define areas to monitor. That is number one. Two, you need to identify which criteria you want to use to set the target. And the third one is define the measurement. So if you want to define the measurement, you might want to use the SMART model, which is specific, materialistic, or measurable, attainable, realistic, and time-bound. You may want to use other models to do that, but make sure that these three things are taken care of, that you define the areas to monitor, you identify criteria, and you define their measurement. And what we are also saying that key performance indicators can work from top down or bottom up. It can. You can take it from the employees to top management. You can drill it from top management to down. And one of the key values to define KPIs is to identify areas of improvement. And once improvement opportunities are identified, it is time to take initiative. And showing initiative is having the ability to charge over a new or unknown world situation. And having initiative is the way for employees also to be more, versatile and in their day-to-day tasks. And it will lead to and produce better problem-solving skills. Mistakes should be accommodated because they will happen. But once they will happen, the question is that what do we learn from that mistake? So we are saying that you can develop initiative by looking at these, four things. The first thing is recognizing spots for improvement. Looking at the spots for improvement. In other words, those areas, they are problem areas. So you're looking at the spots and you've seen what you can do to improve. They might not be necessarily problem areas. There might be areas that have not achieved some significant progress, but we think that we can do more. And showing confidence to share ideas, that is also very important. And then also looking for solutions, not problems. Looking for solutions, not problems, and offering to fill in when gaps would occur. There is that tendency to fill in. That willingness to fill in when we think that there are gaps in there. So if you want to develop initiative, these are the things that you look at. You recognize spot for improvement, you show confidence to share ideas, and you look for situations, not problems, and offering to fill in when the gaps would occur. So this is also very important. Now let's quickly move to risk management. So what is risk management? Now, risk management involves different strategies to identify, assess risks, and prioritize them in order to monitor and reduce threats to a company. And implementing risk management requires looking at the big picture in the future, taking that proper steps for the good of the organization. Now, certain risks may be transformed to what? Opportunities. Certain risks may be recreated as what? Opportunities. But the risk itself is a tendency for some action, not necessarily negative. The tendency that action or the probability that it will happen, okay? And that is what, and the management aspect of it is making sure that the risk in itself is managed, is contained in such a manner that the organization, rather, it inures to its benefits rather than it becoming a problem to the organization. A risk assessment will have to identify all the threats. So we need to do risk assessment, identify all the threats, and there are different types of risk assessment models you can implement depending on the specific objective of the organization needs, and as such, you decide which strategic risks or internal audit you want to do to identify these risks. So a risk management needs to be continuously be part of the organization cycle. We need to assess risks. Most times, if you're in an IT organization, they do something we call vulnerability tests, just to know whether the organization is vulnerable. What is the risk level of the organization? They need to do that. And we are saying that a typical risk assessment approach have to follow these steps. Now, the first thing is to recognize objectives. You need to recognize objectives and then identify potential events. So you use the possible events to determine the risks, potential events that can happen. And if these events will happen, then there's the tendency that, there's risks, also occurring. An example is that if the weather forecasters have told us that it's going to rain, an organization should find out that if it's going to rain, are we in flood-prone areas that if it rains, what is going to happen to us? And if we know that event will happen, then we can take advantage from that. And then when we have done that, the third thing is to identify the risk tolerance, the extent to which we can tolerate what the risks. Can we accommodate it? If we can, then probably we can decide to, sell off the risks to another organization to manage it, maybe insurance or something. And you determine the probability and the impact of the risk. If the risk should happen, what will be its impact? Is the impact going to be bigger or smaller? What is going to be the impact? And you also outline response strategies for the risks. You assign a response for each risk, and this may be to accept, to avoid, to mitigate, or transfer the risk. So you need to outline the response strategy for it, either to accept, either to transfer, either to avoid, either to mitigate it. And then continuously, you do the monitoring of the risk. So these 6 things would have to be taken into consideration when you are doing a typical risk assessment. So there's an example, as you see on the screen, of a risk category, the internal risk and the external risk. So you can see, for example, financial risk. Now, the internal risk is liquidity and cash flow issues. And then the external risk is the fact that you are likely to pay tax and then interest rate and then also on credit. And then the other ones, as you can see them. Now, we are saying that as we established earlier, risk management requires constant monitoring and assessment. So as you gather information using KPIs and other tools designated to monitor progress, you will determine which management strategies are successful and which ones are not as successful. You will know. So sometimes knowing where to invest is obvious. A program that, hemorrhage money year after year, despite adjustment, need to be cut. Similarly, rolling out a product that has customer interest is probably a risk worth taking, okay? You can take that risk, but other answers are not so clear out, even when you have collected what extensive data. So in these cases, taking advantage of opportunity costs will also determine which is worth taking, which one is worth taking. So what we are saying is that, I mean, sometimes you know that putting your money here will bring you some sort of interest, okay? And you know the wrong decisions also to make. Sometimes you are tied between the two. But what is very important is that all the information you need that should help you take that decision in that area that you see a potential risk, the advantages should outweigh what their disadvantages. And you need to also monitor the disadvantages. Those things that are threats, you need to monitor them. And opportunity costs are defined as the value of an alternative for decision. In the economics, those people, economists say the alternate for God, okay, or foregone alternative. So the opportunity cost of being on this in this class is the foregone pleasure or time that you should have spent with the family or something. So in order to determine opportunity cost, however, the cost of it is useful to convert everything to a dollar amount. And in other words, we in Ghana, in cedi amount. For example, the complete cost of employee training when sales are slipping could be calculated, okay? The employee cost of training when sales are slipping could be calculated. And the alternative will be the complete cost of training, the complete cost of not training employees. What it's trying to say is this. You know that if sales is slipping, and we think that the slipping of the sales, we need to do something about it. An organization might decide is that, okay, let's rather do some promo and some ad and all that. But at the expense of training employees, probably the problem is coming from that end. So would you want to forego the training of the employees and rather direct the money into these areas? Would you want to do that? So these are the things that the opportunity cost looks at. And opportunity cost, we are saying it equals selected action minus the alternative decision. Selected action minus alternative decision. In other words, the cost of adverts to bring in more sales, the opportunity cost of the adverts to bring in more sales. Or let me put it this way, the opportunity cost of training employees is the foregone adverts that we needed to do to promote sales. You could look at it from the other side, that the opportunity cost of sales promo is the foregone training that we need to give to employees. Either way, that's how it is. So let's also now look at the learning organization. Learning organization. So we have looked at a number of things. We have looked at the holistic view. We have looked at also issues of KPI, and then we have looked at risk management, and then we are looking at the learning organization. When we say the learning organization, basically what we are referring to is the fact that organizations should always learn from their mistakes, okay? And they should be able to create the conditions for staff to learn. Managers should create that condition. And every day is an opportunity to learn something new. Individuals with business shrewdness and acumen are able to recognize learning events and take advantage of these opportunities. Now, to be successful, you must always be learning. I mean, we keep learning until we die. And as you gather information, you'll find yourself that there's a lot that you do not know. And once you get the information, it empowers you to make, realistic decisions So the ability to recognize learning events will benefit you as well as the organization. Every encounter offers a learning experience. Any interaction with any staff or any of the customers bring a new learning trend. You understand? Or it helps the learning curve. So the key to recognizing learning event is to develop the sense of continuous learning. And identifying 8 different ways that we learn will ensure that we do not overlook learning opportunities. So these are the 8 ways that you should look at. You should, first of all, look at your limitations. That what limits you. So that provides or that creates the opportunity for you to learn. Reception and transmission. Reception is the experience that requires you to receive a transmitted message. And it may be written or verbal, and it can include values as well as academic understanding. So receiving information and transmitting information, you should also look at it. And then exercise. Action rather speaks louder than words. So you need to look at the possibility of always putting into action what you learn. Okay, so we say practice make man what perfect. So these can occur in action that you practice, such as writing. If you have a limitation of writing, you can start writing. Okay, you can start, you make mistakes to correct. So once you don't put in that action or that effort to write, take a pen and a paper and write, that becomes what? A problem. You need to do some sort of meditation and all that. Then you also need to explore. You need to, you need to be inquisitive. You need to explore, searching for answers, discovering information that require individual initiative. This comes from website interviews. It comes from a lot. I learned from a lot of things, sometimes from students. I once gave my marker to a student to teach because I thought that that particular subject, he was an industry expert and I needed to sit and learn. And then you also need to experiment. Sometimes you need to buy some raw materials and experiment certain things yourself, just to see, what will come out of it, because you need a first time experience or a personal experience. Then you also need to be creative. You need to be in a creative process, okay, because that is going to help you. And this can be individual or group of people, ranging from painting to development of new software. You want to do so many things. And then you also need to do reflection. As you are there, you reflect on what you have done. You go into it. Sometimes that's what I do. All the things that I do during the day, when I'm coming to sleep, I try to sit and reflect them. Those ones that went bad, I sit and I write them and I see how I can work on it. And sometimes if I did say something that was not pleasing, I need to go and apologize to that person, either during work or my interaction with students. And you also need to engender or promote what we call debate. Okay, you need to debate people. You need to argue, because life itself is all about argument. We need to argue with people, and that interaction is going to generate some sort of discourse. It will bring new ideas that it will even going to shock you. So we are saying that our past decision often guide our current actions, and both successful and unsuccessful decisions need to be evaluated. And that is very, very important. So once you assess decision, you need to learn from mistakes and achievement. Now, when you take time to learn from all the decisions, even your ineffective choices will bring you what? Success. That is big. When you take time to learn from all your decisions, even your ineffective choices will bring you some sort of success. Okay, will bring you some sort of success. So people prefer to avoid mistakes or problems. However, problems are not always avoidable. When problems arise, you have a chance to learn. You have a chance to learn new things. There are opportunities that present themselves. And the first step to learning from problem is to correctly identify the problem. For example, a shortage in cash flow may cause by loss of sales, unexpected expenses, but that will bring some learning. You know that, okay, if there's no cash, this is what is likely to happen. So you learn from it so that it won't happen. Once a problem is identified, consider different solutions and opportunities. For example, a change in the market may provide you with an opportunity to introduce new products and have that you have been considering for a very long time. And for another example is that if a price reduction helps increase sales and improve cash flow, if that happens, that is going to really help you to know what actually to do, because that's actually what is happening, okay? And if you make a mistake, embrace it. And if you face the same challenge again, you would know how to avoid it. So embrace mistakes, help these things. So in the learning organization, we are saying that we should give the employees the opportunity to create, to innovate. We should accommodate mistakes. We should not tolerate, avoidable mistakes, but we should accommodate mistakes and then use that as the basis, for learning. So recognizing your blind side, and there's something called facade. Let me talk about that. Facade is that blind part of you that you do not see. And once you want to learn, it's important for you to know the things that you do not see about yourself, but people see and tell you. And if you want to look at your blind side, then the first thing to do is request feedback. You request feedback. When you teach people, you request the feedback. When you do something, you have interaction with people, you request the feedback to know. And then when you have done that, you have to reflect on the feedback that you've been given and then see whether the actions that you took were right or not. And then you also need to study. You use books, courses to help become more, competent, and you also build some sort of skill set. So that is actually something that is going to help you. So let's look at financial awareness. There's interest in money. So running a business is a complex enterprise, we know. And in order to look at the big picture in your business, you need to know and answer some basic financial questions. And the first thing is, what makes my company money? What brings money? You need to answer that question. What were sales last year? You need to answer. What is our profit margin? You need to answer. And what were our costs? It's very important that as a manager, you are conscious about your financial issues. Okay, you are very conscious. And here, being conscious of costs and also being conscious of what? Profit. It is very, very important, because we exist in the business to sell goods and services to customers, help them, help the society, but overall, we need to pay our dividend to our shareholders, and we also need to pay our taxes to our stakeholders, right? We need to do that. So it's important that you are financially conscious. Some managers, spend without being conscious. They don't really care about what happens to the organization. You need to be very conscious financially. You need to be very aware. So what makes my company money? Now, the purpose of every business is to generate profit. So the question is, well, what brings the money? Is it as a result of the production of goods and services, or some sort of brand equity that we have created? Is that what is giving us the lead? We need to know this. And that is very, very important. You also need to know which of your products or services, which one gives you the higher percentage of what? Profit. There are products that we do not even invest too much in, but we don't do much kind of advert, we call them cash cow. But they bring us a lot of money, all right? We could have a star product, that will push more money. That's really capturing the market for us, but it's not really bringing us money because we spend more on it. But our cash cow are products that have lived the product life cycle and yet giving us, I mean, astronomical, I mean, values in terms of what? The profits, okay? And that we need to look at. We also need to find out what were our sales last year? How much did we make last year, even last 2 years, last 3 years? We need to look at the trend and see whether we are making some sort of incremental growth or we are dwindling. That is very, very important. So an example is what you see here. We say how to calculate the rate of change and subtract the difference between last year's sales from this year's sales. Now, when you have done that, last year's sales, for example, if it were $90,000 and then this year is $100,000, then the differential here is going to be 10,000 an increment because last year was 90,000 and today and this year is 100,000. Now, you divide increase or decrease by the year, the previous year, the increase or the decrease. So the 10,000, which is the increase, if it were a decrease, you are going to use the decrease figure over the 90,000, which is the base year. Okay, this 90,000, which is the base year, and that gives you 0.111. Then the third thing is to multiply the rate by 100. So when you multiply the rate by 100, then this will give you that percentage in increment. So we are saying that between last year, we did a sales of 90,000, but this year there has been an increment of what? 11%. And therefore, the rate of change between last year and this year is what? 11%. And that's what you see there. Okay, so the other question is, what is our profit margin? We need to know what our profit margin is. Successful companies might have 10, 15, or 20% net profit margin. Others might have more. But the higher the profit margin, the more efficient the business is running. There are two types of profit margin, the gross and the net, gross profit margin and the net profit margin. Both are found when the profit is divided by the total revenue. But let's look at this. This is just an example. So how to calculate the gross and the net profit? So we say you have your net sales, that is 3,000, okay? The net sales is calculated in a certain, you arrive at when you have done, you've gotten your gross sales and deducted all the expenses. That gives you what? The net what? Sales. But look at what is happening here. So your gross sales minus certain expenses that, I mean, happen within the selling of those goods, okay, that are related to it. So we say net sales is this. Then you have the cost of goods sold, the cost of sales, of selling the product. And then that is 900,000. That gives us what? Profit, gross what? Profit. Okay, so net sales minus cost of goods sold give us, give us what? Gross what? Profit. And then we have operational what? Expenses. So these expenses are expenses during the business that we incur. It could be rent, it could be salaries, it could be anything. We call them operating expenditure. We deduct that, and then we deduct other income what? Expenses that were related to income. Then you be taking out the interest expenses as well, and interest that we pay on loan, interest on debenture or other credit facilities that we took somewhere, and it gives us the net profit before what? Tax, which is the 1,002 here, okay? And then once you take the corporate tax out, you have the net profit, and that is how we are able to achieve our profit margin. And it's important that as a manager, these basics you should know, so you know whether you're overspending or underspending. We also need to know what were our costs, okay? The COGS is the cost of goods sold. And these are direct costs that goes with sales. So we need to know the component that goes into that went into it. We need to know our operating expenditure, our overhead what expenditure we need to know. And that should include other expenditures that are not related to what? The cost of the net sales, that is selling what's the product. Expenditure that is not directed towards sales. So other expenditures after we have sold the goods. And then we have our interest component, interest expenses, which could be interest on loans, interest on debenture, or any other investment that we have done. And then we have the federal, state, and local taxes that we also pay, okay? We also pay. So that is about financial. Let's also look at the financial metrics. So now let's look at financial metrics. Okay, financial metrics. And when we are talking about metrics, it's some sort of like KPIs that you look at. I mean, when we are doing strategy. Okay, so financial metrics are and literacy is essential to business shrewdness and acumen. And in order to see the big picture, you have to understand every aspect of the company's finances. Fortunately, anyone can improve financial literacy and the basic instructions and then practice. The main financial concepts are the assets and liabilities, equities, and financial ratios. So we're going to look at these constructs. Now, what are assets? Assets are the possessions of the property and possessions of a business. So a business may own a land and building. A business may have investment at the bank. It's their assets. Anything that they possess. And the liabilities are those money that they owe other people. It could be a long-term liability like a loan, a 5-year loan, a 10-year loan, a debenture, all right, or a bond or anything, okay? That is a liability. Then we have the equity, which is actually both asset and what liabilities that are fused together. That gives you what equity. In other words, we used to call them capital. Now, I mean, the name has changed as what equity. And we are saying that your equity in turn will determine what type of business risks you are in. And lending institution and investors examine your equity carefully. And good equity is associated with being a low-risk investment. And it makes you a low-risk borrower. So essentially, equity is what you have left after paying off all the debt that you owe people. What you have left. And it's a confluence of your asset and what your liability. So as you see the equations down there, equity equation is equal to equity. The equity equation is equity equals asset minus liability, a confluence of it. So, I mean, when we deduct liability from assets, whatever we get become what our equity. We used to call them capital A. So if you want to know the equity ratio, then what you do is you take the shareholders' equity, the equity itself, and then you divide it by the asset, and it will give you your equity ratio. Okay, so that is it. And as a manager, you need to know about this. So let's also look at now under financial metrics, let's look at ratios. Now, ratios are used as indicators in finance and accounting to be able to measure the health of the organization, the financial health, to know whether they are doing well or they are not doing well. And we are saying that there are various ratios that are used to measure whether the liquidity of a company, if we want to know the solvency of a company, these ratios are used. And they are kind of indicators that financial institutions look at when they want to borrow money to you. So we have the return on assets, which determines whether how your net income, your asset is able to finance what your net income. So you have your net income over what total what assets. Okay, so you want to know the percentage of your net income, okay, represented in your assets. You just want to know that. So we say return on assets. So having used these assets to transact the business, okay, how much did we make out of it? What is the return? After using these assets, the buildings and other things to transact the business, we want to know how much we made out of it. And then we have the turnover, the inventory turnover, which is the cost of goods sold over what the average stock or the inventories. It tells us the number of times we've been able to turn our inventory. So the more we turn the inventory, the better for the organization. Okay, if we don't turn it quickly, what it means is that we'll have more stocks, I mean, as closing stocks, I mean, lying down, which will be obsolete or lead to something else. So if you turn it very fast, it helps us. as an it helps us as an organization to be able to what move forward. It's a way of knowing that okay, we are selling more, or in terms of making more sales in terms of what our inventory. Then we have the revenue sales growth. Just want to know the sales growth. So the trend, this year revenue over last year, and then times 100, just to know whether there have been an increment or decrease. That's also a ratio that would, and then earning per share. This one is related to, our stakeholders, our shareholders want to know this year the earning per share over the last year earning per share. Want to know whether, the differential, whether the earnings are going up or they are coming down, depending on the financial health of the organization. So these are indicators. As a manager, without any financial literacy, you should know these things, okay? And if you're a worker and you're working with your organization, these are the things that you look for in your balance sheet to see whether your company is doing well or they are not doing well. These are very, very important. And then another one is the financial report. So the other aspect of financial metrics and literacy requires you to read and understand different reports, such as the income statement is one, and then balance sheet and the cash flow statement. Now, the income statement gives you the trading profit and loss account of the organization. And most times you have your matching your revenue and your cost to know whether you made profit or not. So as you see here, you have revenue, sales or gross revenue, and then you deduct the cost of sales from it, cost of goods sold. It gives you what? The gross profit. And then you deduct gross profit, you deduct operating expenses from it, and then you do the calculation. It gives you the net income, which we say the net profit. And then we have the earning per share for public companies. Other expenses and income may also be included if necessary. Now, when you get the net profit, you need to pay your corporate tax, you need to pay dividends and all that. Then when you are done with everything, we call whatever you get as retained profit. Profit that will not be distributed, or undistributed profit. You need to know the financial statement. Get some of these indices. It's very important as a manager. A shrewd manager should be able to do this so that the manager will be on top of what issues in the organization. We also have the balance sheet that shows the financial position of the business, and the balance sheet shows the financial health. It tells you whether you are doing well or not in terms of your assets and the liability. We say it's a balance sheet because if you have your equity, okay, your equity should be equal to your asset minus liability. If it doesn't balance, then it means that there's a problem. But the fact that your balance sheet balances doesn't mean that you're doing well. But there are some indicators in there to tell you whether your organization is doing well or not. You want to know your current assets. If you want to know your liquidity ratio, you are looking at your current assets minus current liabilities. All things being equal, if they take your current assets, these are assets that can easily be converted into cash. If we take it and then we deduct our current liabilities, how much are we making? We want to know. And then we also have the total asset that includes the long-term assets, such as investment, the physical building, and other things. These are our total assets. And then we have the current liabilities that are liabilities that are within the short term, like taking overdraft from the bank or some credit from the bank, some short-term loan. These are, credits. And then we have the total liabilities, which includes the total liabilities to be paid in the past 12 months. And in addition to that, you have your stockholders' equity. That is the equity of your shareholders. You have that in there. So all that we do in the balance sheet, you have the equity at one side with the liabilities and also the assets at another side. In some jurisdictions, they have the assets and then they deduct the current liabilities from it. And then if it is done in a form of in that order where it's not a T account, you see your total assets and then minus your current liabilities, and then you have your capital. Okay, they call it working capital. And in addition to that, you have your equity and then the long-term liabilities. It's expected that you are able to match the two to have a balance between the equity and the asset minus the liabilities. So that is about the balance sheet. The cash flow also looks at exactly the provides information about how cash is generated in the organization and how it is spent. Simply, that's what it does. How we generate cash and how we spend the cash. So in order to achieve a proper or manage a proper cash flow system, we are saying that you need to consider this thing, and the cash flow must show this. It must show your net cash that is used or provided by operating activities. Used or provided by operating activities. Cash which has been used or been provided by operating activities. And net cash used or provided by investment activities. So operating activities, cash used or provided by operating activities, cash used or provided by investing activities when we're investing, and then net cash used or provided by financing activities. So we are looking at operating activities, cash that has been used or received as a result of operation of the business, and then cash that we have received or spent with respect to what investment, cash that we have received or spent in terms of what financing. We need to look at that. So this is about the finance aspect of the business. And finally, we are going to talk about two main things. The first one is managing disciplines. Okay, amazing. Managing discipline. We are saying that business acumen requires careful cultivation of resources, specifically one of the most important resources and are your employees. And managing people is complex, we know, but developing and managing skills that will help the employees is very, very important. And we are saying that to achieve that, there's something that one has to do, and that is what we call the talent management, change management, asset management, and organizational management. So talent management has been around for some time. How do we tap into the talent of employees and harness it to be able to grow the business? So talent management differs from employee management in development process. Rather than abandoning employees to take tasks, managers develop talent to benefit organizations. So studies have shown that talent management can increase productivity and decrease turnover. Studies have shown that. So if you find talent in employees, don't compete with them, but rather use them to the advantage of the organization. There are many different strategies involved in talent management to improve employee development and increase productivity. Try these strategies, and the first thing is to mentor people. I have a number of people I mentor, right? To mentor them, develop mentorship program, all right? New employees, and then give them the experience. You have maybe 20 years experience, you could deliver that 20-year experience in just a month to equip employees to be able to deliver very well. Invest in them, and then you need to do constant communication with the employees, constant communication. And then when you have done that, evaluate. Choose tools and measures to evaluate the effectiveness of the strategies that you have used, or the survey that you have used. So after mentorship, you invest in them, training programs, continuous development programs. You communicate effectively, which involves active listening and being open and honest with them. And then you also evaluate, choose tools and measures to evaluate effectiveness or your strategies, such as the surveys or whatever you have used. So 4 main things that you need to employ when you want to manage talent in an organization. There's also something called change. Now, change is endemic. Change is something that is constant, and is the only constant thing in life. If you don't change, change will change you. So we are saying that because we are not living in normal times. COVID hit us, and once it hit, an organization has to adjust. So organizations need to learn how to adapt to some of these trends. And this will not be the first time that a pandemic has hit the world. How do we adapt to it? So we are saying that a typical change management process comprises of the following. We need to prepare for the change. That's, you define the change and then identify the change, communicate the change. For instance, if the organization is going to introduce a new technology into the organization. It's a change management process. People would need to adapt. There is a fear of the unknown. Others think that, hey, there's going to be a problem, there's going to be redundancy and all that. Is that really what is going to happen? If that is not it, then you would have to find a way to prepare the minds of the people towards that change journey. You need to communicate to them that this is going to happen and these are the benefits. You need to choose a team, find team to lead the change, inspire people, delegate authority, let them buy into that change. And then you need to sponsor, determine how leadership will actively sponsor the change. There should be a budget for the change management. There should be training. People should be made change leaders or change champions. And then after doing the preparation, that's define, choose a team and sponsor, you go to the management aspect of it. This is where you develop the plans and you take action. So you create the change management plan, you communicate the details, and then you implement it. And then the third thing is the reinforce. And that stage requires that you analyze the change, the surveys that you have used, you have conducted on employees about the change. What are they saying? What are their sentiments? What are their concerns? Then you manage resistance. There are some people who are prone to change. There are people who we call them difficult people. You need to manage them. This resistance, if you have leaders who are bent to ensure that the change doesn't happen, you need to manage them. And that is very, very important. So you need to manage these people. And then when you have done that, where you have identified the gaps, you correct and then you praise. Where you need to praise people, you do that. So you make the corrections, praise individuals who implemented the change. Okay, praise them and give corrective actions for resistance. Okay, those who want to resist, we also manage them and make sure they do not lead us into areas that we don't want to do. And then we talked about also asset management. And as we have said, mismanagement of the organizational assets can have a dire consequences. So it's important that we go through the company or department and know, what assets they have, and we need to list all of them. We know the accountants have the list of the assets register and all that, but we really need to, some of these assets are written off immediately where the organization buys them. They treat them as expenses. For instance, if they are buying like laptops, some organizations don't treat them as assets, but they are in there. So we need to list them. So the first thing, a typical asset management process comprises of the following: involving the departments, okay, determining which department have the assets that need to be managed and coordinating them, and then creating a list, that is the asset register, identifying assets that needs to be managed, and then you develop plan. So you use a separate plan for each of the following: the facility management, maintenance plan, and capital development. You need to do all this. A manager should be aware of this. So we are saying that managing what? Discipline. Organizational management, which is the third one, is the fourth one. We did the talent management, asset management, and organizational management. We are saying that organizational management is unique to each company depending on the structure. It assumes that each singular element is linked to others. So the individual unit as a whole must be managed effectively. It requires planning that will lead to what? The company's goals. And in organizing management, each employee needs to be part of the plan. You begin with the whole skill plan and work your way down to the individual employee level. So from the broad perspective, you trickle it down. The responsibilities outlined in the plan should fall along with organizational structure. It shouldn't be at variance with organizational structure, because there's a structure, there's a span of control, there's how power is delegated, there's also operational activities and administrative activities going on. There's a need to follow this structure. So when this is done correctly and employees understand the expectation on then and how they should contribute to the success of the company. So the structure is what links the different positions. So when you are doing organizational management, there's a need to do that. Essentially, this one, we are talking about the structure of the organization and how roles and responsibility are assigned and the span of control, how many employees are within your ambit, and who do you delegate to, who are your teams, and And we are saying that it's a unique way or a unique way in which each company manage its activities, depending on what the structure of the organization. So that is what it is. Now, the last thing we'll talk about is we are going to talk about two things. The first one is evaluate, analyze, and synthesize. Okay, and we are most often bombarded with information, and it becomes a challenge how to manage this information. So we are saying that the key thing that one should do is to do some sort of critical thinking. And critical thinking is very important because you think outside the box. If you evaluate and analyze and synthesize, then what you're doing is that you are thinking in a manner that creates some sort of, that brings some sort of creativity to the organization. It brings new ideas. So the key critical thinking is asking the right question. Okay, you are evaluating, you are analyzing, you are synthesizing, you are asking the right questions. Whilst you are evaluating, you want to know, compare, you are doing analysis, and then you are synthesizing, you are asking, so why is this thing so? So if it is so and so, what would it lead us to? You want to find out, okay? So we are saying that these questions should be asked. You identify assumptions, and we are saying that is this thing verified? Is this thing verified? You explore perspective. What is another point of view? Because that should not be the only answer. And examine evidence. Why did this occur? You want to find out. Attempt to understand, what do you mean? Consider different implications. Is this important? So you can ask these questions. In fact, you can use this as a model as a manager to help you to think. So for example, a critical thinking question about statistics will be, is this source credible? All right. By asking the right questions, you would weed out useless or harmful information and utilize information that will help you in your endeavors. So it's very, very important that you evaluate, analyze, and synthesize. Essentially, we are talking about critical thinking, and we have outlined these 5 ways to look at these questions that you should ask so that you're able to achieve, that level of thinking, that you will deal with, issues in a manner that will help the organization to achieve its objective. And then you have to evaluate information and conclusions before making any decision. Having asked all these questions, you do the evaluation, and once you have evaluated everything and all facts, make the decision and act on it. Once you have evaluated everything, you make the decision and act on it. If you can feel secure knowing that your decision, you base your decision on accurate and relevant information, you need also to understand the effect of your decision. Every decision comes with risks, and it is not hook, line, and sinker. It is not 100%. There's a margin of error, but you need to take responsibility, having gone through this process. And even if there's a backlash, you see how you can address it. I'm using that same process of asking the questions to address the same problem. So finally, we'll talk about organizational pillars, and this is a short one. Now, there are key organizational pillars that drives businesses, and organizational pillars may be overlooked, but do so to the detriment of the business. Identifying the pillars is the first step to understanding things correctly. And once you understand these pillars, that will help increase business shrewdness and acumen of management. So business knowledge and acumen are not useful if you are incapable of communicating effectively. If you are, no. So the first pillar is investing in people, number 1. So people are the key pillars in any business. People are your grease assets. The people associated with your business are primarily your customers and employees. And if you do not invest in people, you are making a disastrous mistake. Most of us, new employees, because we know that people are going to leave the business, they are going to form their own. So there's this dilemma of either investing in them or not. But if you do not invest in your people, you are making a disastrous mistake. Many companies cut back on expenses related to employees to save money. However, this can backfire, and you can pay that dearly for it. Considering investing in training, equipping them, giving people bonus, giving them advancement, increasing their salary are things that you do to build trust in your people. So to communicate effectively with your employees and customers, be honest and concise with them. Communicate honestly and quickly with them. Be clear with them. Use clear and concise language and avoid confusion. And also be polite. Always answer questions and never interrupt when you are dealing with them. And use a conversational tone and avoid confrontation. These are some key effective communication strategies with employees. Let employees feel part of the organization. They are one of the biggest pillars one of the topmost pillars in an organization. Most people ignore. The second pillar is the key process improvement. The key process improvement in the organization. That is the second pillar. And we are saying that part of looking holistically at the business is goal alignment. It is another keyword pillar. Goal alignment is also is aligning the goals of the managers and employees with the goals of the business. So we have the second one as the process, and the third one as what? The goal alignment. The goal alignment. And we are saying that it is also wise to create smart goals and be specific, measurable, attainable, relevant, and timely. And that's what we are indicated here. So if you want to create this goal, the first thing to do is to do identification. So identify process to change and prioritize the order of change process. Okay, the second one is to establish measures, determine objective and measures used to determine the performance. And then the third one is you determine and validate. You support. You collect data. You look for options. You revise potential projects based on certain criteria, and then implement that change strategy. And then you go for approval, and then finally you evaluate the success against the targets. Okay, so that is very important. So we have talked about the organizational pillars. I've talked about the second one, which is the first one, which is investing in people. The second one that has to do with the process, and also goal alignment, which is what? Also another part of it. And I want to thank you for your time. So what we have done today is to deal with the topic, fundamentals of business shrewdness. I'm going to add a tutorial sections where we're having question and answer, so that it's going to guide you with what you are doing. Thank you so much for your time, and have a good day.